Okay, so I remember asking me the question, why do companies split the stock? Either reverse split or even a forward split. And there's a couple of reasons. One, the reason that companies will forward split a stock, and it used to be very popular 20 years ago, before that, 10 years ago and before, because companies wanted the ability for individual retail investors to be able to buy their stock. And if you look at a stock like, say, Amazon, 2,400, or Berkshire Hathaway, at 25,000 or whatever it's at now, I don't even know. And these stocks generally aren't available to the retail investor. One share of Amazon is $2,400. So companies in that time used to forward split their stock, so that the stocks traded around the $25 range. 10 to 25, a stock would get up to 100. They'd split it 4 for 1. Oh, just let me check. Is it okay? Okay, a little glitch there. So they would split the stock so the retail investor could get involved. But nowadays, with a forward split, companies don't do it as much because retail investors now buy mutual funds. And so big institutions with huge capital base, huge access to capital, they don't care what the price is because they can buy, they can employ $500 million to buy Amazon, or 200 million or 100 million, whatever the case may be. So the price is not so relevant anymore. And so you don't really see forward splits as much as you used to. Now, when we talk about a reverse split, though, for instance, today we saw CHK reverse split 1 for 200. The Nugget was reverse split 1 for 5 today. JNUG was split 1 for 10. So there's a couple of things going on here. The Chesapeake, 1 for 200. So here it traded up to $30 after the reverse split. At a 1 for 200 is actually 15 cents, equivalent to 15 cents. Very, very difficult to raise money at 15 cents a share. You may not even be able to have that many authorized, so you can't raise any capital. Let's just talk about that for a second. So there's two. If you look at it, SEC reporting, the 10Ks and 10Qs of these stocks, you'll see in the financial statement on the balance sheet the number of shares that they have issued in the equity section. There's two numbers. The number says we have, let's just, for an example, I'll just pick these numbers out of the air. Let's say, for example, Chesapeake was authorized to issue 250 million shares. And here I do have an example of this. This is kind of funny. This is GRNF. At 70 cents here, this is 250 million shares outstanding. It's a pink sheet or bulletin boards or not. 250 million shares outstanding. It had 180 million market cap. And they signed all these letters of intent to merge or acquire 11 companies. But if you look at their financial statements, you'll see that there's 249 million shares issued of a possible 250 million. So I said when I tweeted it, and they all got mad at me, I said, how are you going to close a deal when you can't issue any stock? You can't raise any capital, you can't issue stock to acquire these companies. Because you can only issue stock the number that you have authorized. You can't issue any more. So if you look at the financial statements in the equity section of GRNF, you'll see that there's 249 million shares issued of an authorized 250 million. So when you do a stock split, as Chesapeake did here, for 1 for 200. Let's just say, for an example, that they have 100 million shares authorized. Just, I don't know what it is, but let's just say that it's 100 million. And they had issued 100 million shares, so they didn't have any more stock to issue. It was impossible for them to issue any more unless they had, there's two ways they can do it. One, they can reverse split the stock, or two, they could have a special general meeting or an annual general meeting and put it to members to vote, shareholders to vote, to increase the authorized capital to maybe 500 million or a billion, whatever the number is. Those are the only two ways you can increase, or that's the only way they could issue more stock. When there's a stock split, a reverse stock split, it does not affect the authorized. It only affects the issued. So even though Chesapeake, say, had 100 million shares outstanding, authorized and outstanding, if they rolled it back 1 for 200, they now have 5 million shares outstanding, but they have authorized 100 million. So now they can go out and raise capital at a high level, $24 instead of 15 cents, and they don't have to issue. I mean, they can issue 100. They can issue 95 million shares. In my example here, they can issue 95 million shares at $25 a share, whereas before they couldn't issue any stock because it was their capitalization. And at 15 cents, they don't want to raise stock money at 15 cents. It's just too dilutive. So they reverse split it. Shareholders, but the company was in deep trouble anyways. The shareholders get whacked. So if you had 200 shares of Chesapeake, you now own 1 share at $24. You got $24 worth of stock instead of 200 shares at 12 cents. So they can go out and they raise capital. That's one of the main reasons why they split stocks, is that it puts it into an area where they can raise capital. It reduces the number of shares outstanding so that they can issue more stock up to the authorized capital, and they raise the money at a higher level. It also now, the other thing that is, when they do split a stock, this is a bit off on the side, we can see that this, because of the split, this is at, $6,000. Any of this stuff in here is going to be irrelevant as far as technical analysis go in the stock. Maybe in this close in 2-3 months out, that'll affect it. But anything out back here, all these people are gone. I mean, they're absolutely crushed. I mean, their price per stock, or here is $5,000 a share, and the stock's trading at 20. It's down 98% from their price, and all these people are gone. There's nobody left in here. And anybody that was, if they had 200 shares, they only have 1 share left. So there's no effect in the marketplace by all these retail shareholders that own stock in here. There's no actual resistance because there's no actual stock.